פה דקה וחצי, אחר כך יש מישהו אחר. תודה רבה לכולכם. It's my pleasure and an honor to introduce our next speaker, Professor Barry Eichengreen, who is presently the George and Helen Party Professor of Economics and Political Science at the University of California at Berkeley. He's a prolific author of books and articles who for the past 4 decades has put his mind and clearly his typing fingers into understanding both deep looking through history, but also wide looking at, a whole range of different countries, the intricate world of international economics and the monetary system. I mean, how prolific, if you open the home page of Professor Eichengreen, in the What's New part, which refers in the past year, you will find 3 books, 10 academic articles, and 15 more accessible pieces of writings, including he's a regular contributor to the widely read Project Syndicate, and I say it's widely read because I read it, so I know it's widely read. Today he will address an issue which is at the forefront of policymakers' main challenge in Israel. How, as a small, open economy now strongly linked to the 3 largest economic blocs in the world, clearly Europe, the largest trade bloc between Israel is with Europe. The United States, not only important because of the importance of trade relationship, but clearly even more important when we think in terms of the international capital flows, but also China, both through trade and also increasingly through cross-border investment. So how are we to be affected by the divergence of trends in those areas? And as a policymaker, we'll be very happy to hear what you have to say on this matter, and perhaps you'll have a few comments on how we should conduct policy. Thank you. Mary?
Nadine, thank you for the very kind introduction. It's an honor and a pleasure to be here at a conference celebrating the 60th anniversary of the Bank of Israel. When I got the invitation, my first reaction was, how could I possibly not come to Jerusalem during Hanukkah? And my second reaction was, what am I going to talk about? Because, in fact, I don't have a paper on, say, the Israeli economy. So I asked my hosts, and they responded, why don't you talk about the problems for small open economies posed by global monetary divergence? My immediate response to that one was, I don't have a paper on that topic either, but I have some related papers that I think speak to a general issue, and it is about those related papers which look at a variety of historical episodes that bear a resemblance to the period of divergence that we're now experiencing and some of the consequences. So the best part of the talk is, of course, the title, which you've now seen. And the title, the elephants referred to in the title are the United States, which is clearly on course to raising interest rates on the one hand, and China and probably Europe on the other hand, economies that are either slowing down or not growing at the same pace as the US and are likely to move in the opposite direction. So one simple answer to my question about what should small open economies like Israel do about this problem of a divergence is, of course, nothing. It's entirely appropriate to have the kind of monetary divergence between what were referred to as the blocs given very different economic circumstances. In those different blocks, the U.S. is growing more strongly. It follows that it's appropriate for it to have a somewhat tighter monetary policy, a higher level of interest rates than is the case in Europe and China, where growth prospects are not as rosy by the standards of the respective economies. And if the stance of monetary policy is going to be different in the different blocks, it's entirely appropriate for the exchange rates between their currencies to move as well. And that is what we have been seeing over the last year or two, that the dollar has been strengthening against the euro and against the renminbi, reflecting actual and expected changes in relative monetary policies. And I would submit it would be more, we would have more grounds for alarm had we not seen the entirely appropriate change in exchange rates in response to those actual and expected differences in monetary policies. For a country, consider the movement in the dollar-euro rate. For a country like China that has been pegged to the dollar, this is a big deal. This creates very serious problems that the renminbi has been appreciating very strongly on an effective basis because it's been tethered to the dollar, and the dollar has been rising relative to the euro, the US and the Eurozone being of roughly equal importance to China as destinations for their exports. And you will have noticed that on Friday last, the Chinese announced that they were moving away officially from a dollar peg toward a basket peg, which under these circumstances would seem like a rather sensible change in the way they think about their exchange rate policy. Israel, the point came up earlier, doesn't have a dollar peg. So the fact that it has an exchange rate which floats subject to various degrees of management against the dollar and the euro is perfectly fine. One of the principal components of Israel's effective exchange rate is strengthening. Another component of the principal components of Israel's effective exchange rate is weakening, and to a first approximation, the two effects wash out. No big deal for the Israeli economy. Why should policy respond in one way or another to this divergence in policies between two of the country's principal trading partners? So that's what this slide basically says. Events in the two economies, or two sets of economies to which Israel looks when it thinks about exporting, will largely offset one another. The US is now growing faster. The US is no longer at risk of deflation. So it's appropriate for the US to begin raising interest rates. China and Europe are growing more slowly for sake of argument, and at continuing risk of deflation for sake of argument. So it's appropriate for them to reduce the level of interest rates. It follows, given their respective growth prospects, the US will absorb more imports. China and Europe will absorb fewer. The two effects will more or less wash out from the point of view of a small open economy like Israel. Higher interest rates will curtail capital outflows from the US, while lower interest rates in Europe and China will boost their capital outflows. And from the point of view of small open economies in the rest of the world, the two effects will, to a first approximation, wash out. So no obvious asymmetric impacts on other economies, no reason to adjust policy. To a first approximation. So to a first approximation is not good enough for practical policymakers, and we can think of a number of reasons why that simple reasoning is too simple. On the side of the current account of the balance of payments, the US and China import different things. China imports more energy and commodities. The US imports more consumer goods, electronics, et cetera, so it matters a lot who you are and what you export. From the point of view of Israel, these divergences are, again, probably a good thing more than a bad thing. You're not an energy exporter yet, but you're an exporter of merchandise and other stuff that China doesn't import that much of, and the U.S. imports a whole lot of it. The effects are not entirely neutral, on the other hand, on the capital account side, because the dollar, I keep saying the dollar on the one hand, and the euro and the Chinese renminbi, on the other hand, do not play exactly the same role in international financial markets. The global banking system runs on dollars. The dollar accounts for 80% of global trade finance. The dollar is on one side of 85% of global foreign exchange transactions. The dollar accounts for 42% of all international financial settlements through SWIFT, which means that when dollars become more scarce, which is what will start happening on Thursday, the renminbi and the euro cannot substitute entirely. There have been a variety of research papers that document these points, especially this last point, in a more systematic way. Here is one by a couple of Bank of Canada researchers. I saw Charles Freeman here a moment ago, that concludes that a common component heavily associated with U.S. monetary policy has historically accounted for about 75% of the variation in international capital flows, looking at data, aggregating data across a wide variety of different countries. We have a variety of historical experiments that we can use to analyze that common component, and that we can also use to investigate how different countries may be affected differently, and how country characteristics and country policies can shape the impact of this common component. So I have done some work with Poonam Gupta at the World Bank, looking at periods when capital inflows into emerging markets drop abruptly, and how the determinants or the correlates of these sudden stops in capital flows have changed over time. So we find, for example, that external factors have become increasingly influential over time as determinants of sudden stops, and that the external factors that matter have actually been changing over time. Once upon a time, meaning in the 1990s, US monetary policy did play a powerful role in influencing the timing of these interruptions to sudden stops in capital flows. More recently, it has been changes in financial volatility, global risk appetite, the kinds of things captured by the VIX that have been influential in explaining the timing of sudden stops. So we have a variety of natural experiments, historical episodes that we can use to investigate what kind of countries experience sudden stops and suffer adverse consequences from them. Mr. Bernanke, in his wisdom, in 2013, gave us a natural experiment when he uttered the T word, taper, and capital flows to emerging markets stopped abruptly. So Gupta and I have looked at that episode between April and August of 2013 and asked which countries experienced large effects, large reversals in capital flows, and sharp depreciation of the exchange rate, and why. I am unable, given my hindsight and the limited resolution of the original in this case, to pick out the data point for Israel, so I apologize. I'll show you some Israeli data later. But what we have on the horizontal axis here is basically how much capital countries had imported in the period prior to the tapering episode between 2010 and 2012. If you're on the right-hand side, you had imported a lot, and how much your currency depreciated during the taper episode between April and August of 2013 on the vertical axis. And you can see that the countries that had imported a lot of capital in the preceding period were the ones that suffered the biggest shock in terms of currency depreciation after Bernanke made his comments and the markets concluded that US monetary policy was likely to normalize sooner rather than later. We found that countries that had allowed their real exchange rates to run up the most, to appreciate most sharply during the preceding period from 2009 through 2012, saw the largest depreciation subsequently. More surprisingly, we found that countries with the largest financial markets in absolute terms saw the greatest largest currency depreciations during the tapering episode, something that you can see here as well. So this effect is robust to including a variety of controls. What it seems to be saying is that relatively small countries with limited market capitalization suffered a smaller hit during the tapering episode, as if it was hard for investors who wanted to rebalance out of emerging markets to easily liquidate their positions in smaller markets. So that may be a mild source of reassurance for Israel. The results of sudden stops like the one that occurred during the tapering episode and other sudden stops previously, we know are uncomfortable because the reversal in capital flows is associated with tighter financing conditions. It is associated with higher inflation insofar as it gives rise to currency depreciation. It creates a heavier burden of dollar-denominated debts. It leads to a loss of reserves insofar as the central bank feels compelled to limit the depreciation of the currency because of the burden of foreign currency denominated debt. And these episodes tend to be associated with recession insofar as resources can't be shifted from the production of non-traded goods to the production of traded goods overnight. So Gupta and I have looked at capital flow reversals in emerging markets, in 35 emerging markets since 1990, looking at periods when financial flows, portfolio capital flows, and trade finance, which show up in the balance of payment statistics of the World Bank and the IMF as other capital flows, when these flows decline by at least one standard deviation below their average level over the previous 20 quarters, and they stay at least one standard deviation below for a couple of quarters or longer. So when you look at 35 emerging markets, you find 4 dozen such episodes. They last on average almost a year, and the capital, the reversal in capital flows is substantial. I think I can show you that here. So the Over the prior 5 years, the capital inflow averages about 1.5% of GDP, and then it swings to in these episodes to a negative 1.7% of GDP. In the first quarter of the sudden stop, 1.6% outflow in the second quarter of the sudden stop, and so forth. Incidence tends to be clustered over time, again suggesting a role for global factors, either US monetary policy or the VIX or something else. Different countries seem to have experienced sudden stops in the 1990s and not to have experienced them again in the 2000s. These events then have a major impact on the exchange rate, which was relatively stable, the nominal exchange rate on average during the period of inflows, then depreciates markedly by 10% in the first quarter of the sudden stop, by another 10% in the second quarter before beginning to stabilize, forcing the authorities to spend reserves and raise interest rates to limit the magnitude of the depreciation and the impact of that on the balance sheets of corporations and banks, with a major impact on growth, which was in our 35 emerging markets, which was modestly positive over the last 4 quarters before the sudden stop, and then turns sharply negative, mainly because of the collapse of investment, which takes place in response to the end of capital inflows and the tighter financing conditions that follow from that. So, and with a major impact on the ability of countries to finance current account deficits, which were substantial before the sudden stop and then are compressed radically starting in the second quarter of the episode. So you can look at emerging markets since the beginning of the 1990s, or you can basically do the same thing for a more limited set of countries over a much longer period, which I've done with another co-author. So the methodology, the precise criteria we use to identify sudden stops or capital flow reversals is a little bit different in this earlier period, but compatible, consistent with what I was describing to you before. So here we focus on successive 3-year periods between which capital flows declined by at least 2% of GDP. We find that there are a lot of those episodes in our sample of 20-plus countries that we follow over time. A lot of them in the 1920s and early 1930s, when international capital flows were basically unrestricted. A lot of them in the post-Bretton Woods period since 1970. Considerably fewer, not surprisingly, during the Bretton Woods period when capital controls were pervasive and financial capital flows were less. We find that those drops in capital inflows were costly. In the interwar period, growth was 2.7 percentage points slower in the first year of a reversal than in the typical non-reversal year. Under Bretton Woods, the decline in growth was even larger. Interestingly, the slowdown in economic growth, 1.8 percentage points in the first year of a reversal compared to a typical non-reversal year, has been smaller since 1970. So even if we see here in the previous slide that Compared to the 1950s and 1960s, reversals have been growing more frequent. Maybe they have been growing a little bit less costly. Maybe we have been making some progress in terms of managing them. I'm not sure. There are too many coefficients here, and the resolution is too dim for the table to be effective, but what it shows when we analyze incidents over this long period is that capital flow reversals are not random. They're more likely in countries with large current account deficits, consistent with what I was saying before, in more open economies, and also in relatively poor countries, which it's tempting to interpret as indicating in countries with relatively weak institutions. Nor are the costs random. Reversals are more costly in the sense that they are associated with larger declines in the growth rate in countries with large current account or trade deficits, in countries that had allowed the real exchange rate to become seriously overvalued in the preceding period, consistent with what we saw in the tapering episode, and in countries with relatively open capital accounts. So what is to be done about this, to return to the motivating question, to return to my charge, if you will? I think these episodes, this earlier historical experience suggests that countries on the receiving end of large capital flows, countries that allow their real exchange rates to appreciate and become overvalued in response, find themselves over a barrel. So I wrote this phrase sitting at my computer last week, and I began to wonder whether the phrase over a barrel is used in Israel or not. So I went to look up where it originated, and of course it originated in Raymond Chandler's novel, The Big Sleep, which the film version of which you will be more familiar with, but the Rand McNally online dictionary defines over a barrel as in a helpless position, at someone's mercy. And that's the condition of countries on the receiving end of large capital flows that allow their real exchange rates to run up while that capital is flowing in. If they then allow their exchange rate to fall when the capital inflow dries up and turns into a capital outflow, firms with dollar-denominated debts can be bankrupted. If instead they attempt to intervene to prevent the exchange rate from falling, reserves will decline. Exports can't be substituted for domestic demand, and recession is likely to follow. So I won't use a different metaphor, having already introduced one. They're over a barrel. So that suggests that prudent international financial management in the presence of large capital flows has two elements. Number one, limit the capital inflows and the resulting current account deficit, resulting real exchange rate appreciation, resulting domestic spending boom in the period when foreign interest rates are low and the capital is flowing in. Second, keep your powder dry so that policymakers have room for maneuver. They have bullets that they can use when the inflow dries up or reverses. And then I began to think, is keep your powder dry a phrase commonly used in Israel? I went to remind myself of where it comes from, and of course it traces back to Oliver Cromwell. Put your trust in God and be sure to keep your powder dry. So this should be a phrase that's used in Israel, if it's not. So limiting capital inflows, easier said than done. Monetary policy is of no use for limiting capital inflows. Raising interest rates to damp down the resulting boom will only attract more capital, but lowering interest rates to discourage inward foreign investment will only fuel that domestic spending boom. Capital controls are one possibility, but they're difficult to apply in financial systems that have been liberalized and opened. They're harder to make effective in a world of financial globalization. Tight regulation of banks might be one alternative, which has been tried in Asia since the Asian financial crisis, but that may only encourage corporates to borrow offshore instead, and that has been exactly the Asian experience. I draw the conclusion that the only so that foreign exchange market intervention may help a little bit for a little while, and that may have been part of Israel's experience as well. So we heard earlier that that accumulation of foreign exchange reserves by Israel may have been a way of building up a financial cushion, but it also may have been a way of limiting the appreciation of the exchange rate in a period when overvaluation could have become an even more serious problem. Still, I conclude that the only effective tool for limiting capital inflows in a period when US interest rates are zero is fiscal policy, that fiscal consolidation is the appropriate tool to use under those circumstances. It puts downward pressure on local interest rates and makes the carry trade less appealing. And it damps down the domestic spending boom that is the symptom of the foreign capital inflows. The question being, are sharp adjustments in domestic fiscal policy in response to international capital movements and changes in global financial conditions feasible or not? Can fiscal policy be adjusted quickly in response to international capital flows? Is it available politically under those circumstances? So I don't know. I go around the world advising governments, if they care to hear my advice, that if they're experiencing capital inflows, they should tighten fiscal policy while that's going on. And the response I get is correct in principle, awfully difficult to do in practice, and that's true. What do you do when the inflow stops and the direction of capital flows reverses? Constructive responses are possible only if policymakers have kept their powder dry. Monetary policy can be used if macroprudential policy has been used before the fact to limit currency mismatches, which requires not only strong bank regulation, but strong corporate governance so that the corporate sector doesn't run up large, unhedged foreign currency exposures that limit the availability of exchange rate policy. Fiscal policy can be used only if governments have fiscal space. So if the capital inflow stops and domestic demand weakens, it would be nice to be able to expand fiscal policy under those circumstances, which you can do only if you don't already have a large deficit and you don't already have a large public debt. So I conclude that there's much to worry at the moment about what's going to happen in emerging markets now that they are going through a sudden stop because they haven't kept their powder dry. The Asians haven't done in terms of macroprudential regulation what they should have done vis-a-vis the corporate sector in particular. And there are a lot of emerging markets, can you say Brazil, with debt and deficit problems for whom fiscal policy simply is not available. So they can't use monetary policy, they can't use fiscal policy, they are undergoing a sudden stop, and they have to basically suck it up and live through the episode. So there are some countries with large deficits. There are the Brazils and Indias on the right. There are some countries with large debts. So I looked it up during the break. Of course, Israel is exactly in the middle of this figure, not among the countries in the worst position to use fiscal policy at the moment, but also not among the countries in the best position to do so. You're not down there with Hong Kong. On the other hand, if I understand correctly, Israel doesn't have the problem that virtually all the Asian emerging markets have, which is large amounts of foreign currency, in other words, dollar-denominated debt in the corporate sector, which makes their financial situation very fragile in the face of currency depreciation. So if that's not a characteristic of the Israeli economy, that clearly is good news. So the implication is, remember the wisdom of Raymond Chandler. Thank you very much. We don't have time for questions, so I'm happy to let you go to the panel and we can do questions together at the end.
You mentioned about governing the corporate sector. Many countries have the kind of regulations or laws enforced that would allow the authorities to prevent corporations borrowing abroad.
So I think after the Asian financial crisis in particular, you were there, you will recall, the emphasis was really on corporate governance. Strengthening boards, strengthening transparency, so that both corporate insiders and boards of directors on the one hand and markets on the other hand would better limit the development of unhedged exposures and so forth. But are there countries that use macroprudential regulation to limit outright unhedged foreign currency exposures? I can't think of examples offhand.
In the run-up when capital inflows come in, you ruled out a few policy options. Can you say something, maybe you said it and I missed it, about the intervention in foreign exchange markets? Why is that not an effective policy?
Well, I think foreign exchange market intervention can work to a limited degree, and it can limit the appreciation of the exchange rate, which gives rise to overvaluation problems, current account deficits that are then hard to compress without recession. Overnight, there is a debate in the academic literature about whether intervention that is not eventually backed up by a supportive monetary policy has sustained effects or not. Foreign exchange intervention is not without costs. If you're buying a lot of low-yielding assets, and at the same time the consolidated public sector is issuing a lot of higher-yielding government debt. So I do think the first best instrument under those circumstances, when the two problems are number one, local interest rates are high relative to the rest of the world and domestic spending is booming, tighter fiscal policy addresses both of those problems directly, and in an ideal world, that would be the response. Seeing no more questions, I'm happy to let you go on to the panel.
Thank you, and good evening. So we've reached the final session of this conference, and we'll hold a panel with three distinguished colleagues at Small Open Economy Central Banks. We'll start with 3 short presentations by my 3 colleagues, and then we'll move on to sort of a question and answer panel discussion, and also hopefully we'll have time for questions from the audience. So we'll start off by the order of the program with Dr. Niels Hansen, the Director of the Economics Department at the Bank of Denmark, and he'll start with his presentation.
Thank you. So this is our central bank. I think it gives a wrong impression right now. This is not the weather we have at this time of the year, at least. So, yes, thank you for inviting me here. I'm really honored to be here, to have this invitation and to participate in the celebration of your bank. Thank you for that. And for letting me talk about the Danish experiences. So my talk will have 2 perspectives, so to speak. One longest perspective on fixed exchange rate policy in Denmark, and then a shorter perspective on recent experiences this year with negative interest rates and capital inflow. So let me start with this chart here. That's our exchange rate, and you can see bands around it. So we've pursued a fixed exchange rate policy since 1982. At that time, the country was really in big troubles. People were talking about the economy approaching an abyss, and a fixed exchange rate was installed by then, together with 2 other measures. One was the suspension of automatic wage indexation, and another was a fiscal tightening. And you can see then there were some changes in the parity throughout the 80s. It was never on a Danish initiative within the ERM system. And then since the beginning of 87, the central parity has been unchanged. Volatility was higher in the first years, and then came the ERM crisis in the beginning of the 90s, and the band was widened. And then slowly we moved back towards the parity, and since the mid-90s, the krone exchange rate has really been very stable. You hardly see any fluctuations in it, and whatever crisis there has been during these years, it's not in the exchange rate you see it. So this means that our interest rates, of course, our monetary policy is solely directed towards keeping the exchange rate stable. So we don't take other considerations into account. So stabilizing the economy is really up to fiscal policy, and I think some of the things we just heard from Professor Eichengreen also goes for a country like Denmark. So it's very important that fiscal policy is disciplined and in line with the economic situation, which it has been, generally speaking, throughout the years. Fixed exchange rate means also that policy means that price developments will eventually follow those of our anchor, and our anchor is the euro. It was the Deutschmark before the establishment of the EMU, and you can see this very clearly here, that we have more or less the same price development. I mean, there can be swings from one year to the other, but over time, this is very much in parallel. It shows also, of course, that with a fixed exchange rate, it's important that institutions in the economy adapt to it. So, and we see that in wage negotiations, for instance, in public policy, is really aligned to this policy. So wage negotiators, they know that we cannot come and rescue them if they negotiate too high wage increases and so on. So this also is also a reflection of that. So I said you cannot see anything in the exchange rate, but here is where you can see when there has been some capital flows in and out of the Danish kroner. Usually back in time, when incidences occurred, it would always be a capital outflow, a small open economy in a big world. That was typically the case. Denmark was a net debtor nation and had to defend its currency every now and then. And you can see these incidences here. You have the first part of the 90s after the ERM crisis. Then you have the Asian crisis in the late 90s. 2000, it was the Danish referendum on the euro, where we voted against joining the euro for the second time. And then you have the financial crisis, where we really stand out. I think if one will ever have a natural experiment on monetary policy regime, that's the one occasion to study, because unlike other countries that lowered their interest rate, actually we had to increase them to defend the krona because money was flowing out of the country. But this whole thing then reversed again, and we were able to bring interest rates down. And then two episodes in recent years which are really different, because these are the first episodes where we saw capital flow into the country. So we, in late 2011, 2012, the Danish kroner became, so to speak, a safe haven with the problems we saw in some the debt problems we saw in the euro area. And also more recently, this year, we have seen capital flowing into the country, but this is actually relatively new. Yeah, so I mean, for a small open economy like Denmark and Israel and others, the question is, of course, which monetary policy regime is the best one. And well, my take on this, and I have just shown you some figures here, and I have done some econometrics also, econometric studies, is actually, for at least a country like Denmark, it doesn't matter that much. And you can see also here in terms of macroeconomic performance, comparing with Sweden and UK, it's more or less the same. We have the same volatility of inflation, of the output gap, and so on. Of course, we have much less variation in the nominal effective exchange rate and also in the real effective exchange rate. But the important macroeconomic variables, I mean, show more or less the same economic performance. And I know this is, of course, very superficial, but I mean, my own econometric studies and what I read also is that the important thing is really not whether you have one regime or the other, but you have a credible nominal anchor that you follow consistently. So, and of course it brings us also to the question, so what kind of monetary autonomy do we have as a small country? Again, I compare with Sweden, which is, Sweden is similar to Denmark in many aspects, except for monetary policy. They are, of course, pursuing an inflation target policy. And you can see here, interest rates are more or less the same. I think I would relate this, for instance, to the recent work that we have seen from for instance, Elaine Ray on the existence of a global financial cycle and so on. It looks very much the same. So monetary conditions are pretty much the same. So now coming to this year's experience in the country. So in the midst of January, after the ECB announced its QE, and then on the day where the Swiss National Bank, I guess we'll hear that later, lifted its floor against the euro, we suddenly saw a lot of capital inflow to the country. In the first place, it was foreign investors. I think they were thinking, well, we saw the Swiss abandoning their floor against the euro. What other countries are there? Well, Denmark was the obvious country to look to with our fixed exchange rate. And So I think they would see whether we were actually willing to stick to our fixed exchange rate policy. I think what they might have forgotten is that we have 30 years, more than 30 years of experience with this. We have a very clear political mandate to pursue this policy and the will to defend it, and we also showed that in the following time. But we saw a very huge amount of capital inflow in the last days of January and in the beginning of February, and we increased our reserves quite significantly. The increase was something around, I think, a little less than 15% of GDP, taking the reserves to something just a little less than 40% of GDP in total. So that's what happened in these days after the midst of January. But it was not only foreign investors. A few days later, also some Danish investors, pension funds, followed, and you'll see that in a little moment. Yeah, you will actually see it here. So this is these are the different sectors or investor types that invested in the Danish kroner. You can see in January it was well, actually it was not only these non-residents, the Danish pension funds and insurance companies came soon after. Then from March on, the whole thing turned around. I mean, and this is related to the fact also that we lowered our interest rate very significantly. I'll come to that in just a little minute. But foreign investors, as you can see here, are now out of it, or have brought their exposure to the kroner down again. Danish pension funds and insurance companies not fully. And other domestic residents neither. So, yeah. So, but what is it about these insurance companies? I mean, we have in Denmark a very large funded pension system, a bit like in the Netherlands. So these funds are huge, really huge, and of course they cannot only invest in Danish kroner; they go abroad. And typically, when they invest in euros, only a small fraction of this euro exposure is hedged because of the fixed exchange rate policy. So they consider the two currencies more or less the same. But with the events there in January, they just changed this hedge share that they were hedging just a little bit. But since these amounts are so big, it really had a big impact on our reserves. So, yeah. So not only did we intervene in the foreign exchange market, we also lowered our monetary policy interest rates, and in 4 steps we brought it down to -75 basis points. So that's the lowest level, together with the Swiss that one has ever experienced. Our reaction function is typically that well, in a sense, there are 3 lines of defense. In the first place, it's typically the banks, when there are capital flows, that take it in their books because we have a credibility, and then they know that we are going to defend the kroner, so they do that in the first place. But if tensions are of a certain size, they will step out, and we then resort to interventions to a certain point, and then we'll resort to changes in the interest rates. We did that as well here, and lowered our interest rates down to -75 basis points. But then at a point we said, well, in this situation, we believe we can go lower on interest rate. But we said we can supply all the kroner that people want. and started to do that, and that's why, of course, the reserves increased so much. That's, of course, different from the situation when the capital flows out of the country. Similarly, we earn money on this. As long as the kroner remain fixed, we earn money because they make deposits here at minus 75 basis points, and we can put them elsewhere at a better interest rate. So, and investors on average, at least, they lose on this. So, the important thing here is that even with these negative interest rates, we saw a transmission to the money market, just as usual. You can see the money market rates going down, which is important for the kroner rate, because that's what's important for the kroner vis-a-vis the euro. And the money market rates even went below because they expected us to lower interest rates even further, and then it went up again when we changed our pattern, so to speak. Yes, I think I'll go on quickly. So what about the transmission to the rest of the economy? Well, there is some difference here. If you're a household or a small firm, you typically are not faced with negative interest rates, or typically you are not. They get, say, in general, a zero interest rate. However, if you're a big financial corporation and will make a large deposit, in that case, you're actually facing a negative interest rate, if, say, minus 75 or minus 1%, which is, of course, also important for the transmission of our monetary policy. But it's also, I think, important that households are not paying a negative interest rate for making deposits. I'll come to that in a minute when we look at the currency in circulation. What about other market rates? Here we have mortgage yields. They became negative. At least mortgage with a short duration, 1, 3, and even 5 years at a time. If you're a house owner and you have a loan, this is actually the rate you pay, plus a fee, which would be something between, well, a little less than 1% maybe. So some house owners actually have faced a negative interest rates on their mortgage. This has created some technical issues to be solved. I think it is solved now. How do we deal with negative rates on mortgages? There are also some other legal issues that one has to deal with negative interest rates, say in terms of when firms say have a tax account or an account with tax authorities. Should also be able to have negative interest rates. So there are so different issues to deal with negative interest rate. But apart from that, I think the things are working. And we have been able to deal with those negative interest rates, and we have seen the transmission to yeah. I don't have a chart on that, but of course, just like other countries with low interest rates, I think there's not much of a difference whether low or negative. It's low interest rates. So this is, you can say, a concern. So what happens with negative interest rates? This is something we're looking at. We can see our housing market. We have seen prices going up. Not to the same extent as say, in some other Nordic countries. We had a huge decline in housing prices just after the financial crisis, because the Danish economy actually was overheated also for domestic reasons before the crisis. And house prices are only back to the level before the crisis. But we have seen price increases in Copenhagen, for instance, of 10% per year, which is, of course, I think, unsustainable in the longer run. More recently, we have seen a moderation. So I think it's contained, but it's certainly a matter of of concern. And then my final slide here is, of course, one limit to as how low can you go with interest rates? I think the important issue here is, well, people go into cash. We don't see any of that. This development that we've seen recently is just within the normal range. The important thing here, I think, is that Danish households have not faced the negative deposit rates. If they were to do that on a large scale, this might look different. So all in all, we have been able to cope with these negative interest rates. I think I'll stop there.
So we move on to our second speaker. This will be Thomas Moser, alternate director, governor, at the governing board of the Swiss National Bank. He's going to talk about another country with negative interest rates. So.
Let me first also thank the Bank of Israel for the invitation. It's a real pleasure and honor to be here. And I'm also struck about how similar the challenges for monetary policy are between Switzerland and Israel, which is also one of the reasons why we are actually in contact and have been exchanging experiences early on, already in 2010, on foreign exchange interventions, for instance. So the exchange rate is clearly an issue, and also then macroprudential policies given the low interest rate environment. So in Switzerland, let me start with the mandate. So unlike in Denmark, we are usually not having a current an exchange rate policy, but we have something very similar, like I think in Israel, a flexible inflation target. We have never called it an inflation target for several reasons. We have a very long history of low inflation. We came out as the last central bank, I think, among at least the advanced economies from monetary targeting. So we only changed to this system at the beginning of this millennium. But to show you also how much flexibility we have, and I think this is sometimes astonishing for some people, in the Constitution, I think the important thing in there is that we have in the Constitution the sentence that the central bank is independent. So that's in the Constitution. But in terms of the objectives of monetary policy, it doesn't say much, except that it should be in the general interest of the country, which can be almost, I mean, you cannot disagree with that. Then if you go into the law, you see that it's not really very specific either, but it says here, and I think that is similar again, that it says price stability is the primary objective, and then there is a secondary objective that says it shall take due account of the development in the economy. So we are somewhere in between the ECB and the US, and I think it's very similar here, that prime objective is price stability, but we should also take other issues into consideration, particularly the real economy. So what we did with that mandate, which is not too specific, is that the Swiss National Bank defined on its own and can define on its own without the government what we have to understand under price stability. And here we said everything below 2%, which we had to clarify in the most recent period, means everything between 0 and 2% we are happy with. And one of the arguments why we have never been more specific, also not more specific in terms of how quickly we have to return within to this band if we are outside. One of the arguments we always used is that we said we cannot fine-tune inflation, given that we are a small open economy where the exchange rate and exchange rate shocks play a large role. We are happy when we are between this 0 and 2, but we are not trying even to steer an exact, to go to an exact number within this band. The historic average is around 1%, the long-term average. So another thing maybe to point out is that in terms of our operational targets, the interest rate that we use to achieve our policy objective is the 3-month Swiss franc LIBOR. So this is not like most other central banks an overnight rate. It's a relatively long, it's a market rate, it's a 3-month rate, which I think is a little bit specific. And the way we steer this in normal times, this 3-month LIBOR is with repo transactions, 1 week to 2 week repo transactions. Here we have the full flexibility. When we actually implemented this system, the IMF told us that this doesn't work. You will never be able to steer the 3-month LIBOR that is set in London, not in Switzerland. It worked very well, and I think it even had some of the advantages. Of course, now we have the whole LIBOR issue, and we have to rethink this again. Now, if you look at the actual inflation experience, and here is another similarity with Israel, is that we are experiencing negative inflation currently. So you see similar, when I looked at the graphs that the Governor Fluke showed us this morning, that we had, when you had negative inflation already earlier, we basically touched zero. Right now we are also in negative territory, and I think one message here is that it's possible to have negative interest rates. It's not something that terribly bad. But of course it depends, I think, where it comes from. And most of it, if you look at the contribution to this inflation or negative inflation or deflation, people usually don't like the word deflation, so we call it negative inflation. But if you look at it, then most of it still comes from imported prices and from oil. But I think very recently, as you can see, we also see domestic prices, including services, to go negative. So this is clearly something to watch. But generally, most of it comes from imported prices, which is less of a concern. It comes from the exchange rate shock. Now, talking about the exchange rate shock, so this was here our experience. This is the real effective exchange rate, and we have generally a history of real effective appreciation over the long run. This kind of longer history was interrupted during the Great Moderation, and you see that we had a relatively weak Swiss franc during the Great Moderation. There was no demand for a safe haven, which the Swiss franc usually is. After having seen Barry Eichengreen's presentation, I don't know whether we should rename the Great Moderation the Big Sleep, because there were clearly things going on that we didn't realize that were going on. But you can see that when the crisis started, the Swiss franc started to appreciate. And the most dramatic situation for us was in 2011, when we had, in summer of 2011, within 1 month, we had a real appreciation of 30% within 4 weeks. That's when we then introduced the floor. I will say something about that soon. But you see that we managed to get the exchange rate back with this intervention. Until then, also mentioned already today, January 15, when we lifted this floor and had another quite strong real appreciation. Now, so why did we do these things? And I think it was interesting to see the presentation of Professor Krampf talking about these 3 episodes and kind of asking the question whether central banks most recently have become less conservative or whether there's something going on. And my answer to that would be clearly what has been going on that we all came to the point where we actually ran out of powder. We came to a point where we couldn't use our instruments anymore and had the choice of either doing nothing or try new things. And for the Swiss National Bank, this was the same. We first lowered interest rates very aggressively. You see here a comparison between Switzerland in blue, the US in red, and the Eurozone in yellow. So we were very early on very low with our interest rates, 25 basis points, which I think at the time was considered to be more or less the effective lower bound. And also remember that this blue line here in Switzerland is a 3-month rate compared to the overnight rate. So when we are at 25 basis points with the 3-month rates, we were already negative with the repo rates to get the LIBOR that far down. In 2011, when we had this dramatic appreciation, we went one step further and took the 3-month LIBOR to 0. And then we already prepared for the possibility to going negative. And we were lucky enough that the Danish central bank went ahead with this natural experiment, and we watched it very carefully when in 2012 Denmark went negative, and the conclusion we took from that, we also had an exchange on the experience, the conclusion we took from that is that negative interest rates work. And I think this is one of the underappreciated topics that probably will become more prominent over the next years, that negative interest rates, if you are able to actually remove the effective lower bound by dealing with this problem that people can switch into paper currency, that you might extend monetary policy, just normal monetary policy, into negative territory, that you can keep or stay with your usual instruments instead of having to go into new areas like QE and other things. But I know this is a very hot political topic. People don't like to talk about restrictions on paper currency, so this is a very difficult topic to talk about, but I think it's clearly worth to explore this issue further. So the same experience here, like in Denmark, it works. It works quite well, and 75 basis points negative is not yet the effective lower bound. I think one of the reasons is that apart from insurance costs, there's also a lot of inconvenience if you want to hoard a lot of paper currency. There are issues of money laundering laws. When you bring that back into circulation, there are issues that the insurances actually give you a cap. So it's not that you can just store any amount of paper currency that you want. You have clear caps. We were told that the cap in Switzerland is $3 billion per object. So there are clearly issues here, but it's more costly than I think originally assumed to store paper currency. So this is one of the instruments that we used. The other one, as I said earlier on, was this exchange rate floor. And when we introduced that, we had, of course, discussions within the central bank, and most economists would tell you, if you want to do something like that and put a floor or a ceiling, however you look at that, that you should do a basket or take the effective exchange rate from an economic point of view. But people with financial market experience specifically told us that's not the way to do it. Use something very simple. And so we decided to do this floor with basically a relatively straightforward number against the euro. So it was a bilateral exchange rate floor against the euro. And we had also long discussions whether this would work or not. When you just come out one morning and say, from now on, we set the ceiling, and the ceiling was clearly above below where the actual exchange rate was, about 10% below. At the same time, we set the ceiling at the level that we still considered where it still was considered to be overvalued, so it would become cheap or easy to defend. And actually it worked quite well. It took about 4 minutes for the foreign exchange market to establish that exchange rate, and we did not have to intervene a lot on that first day, only a little bit in the end, but basically that was just a verbal intervention. During these 3 years where we had this exchange rate floor or ceiling, we had to intervene in 2012 when there were severe concerns about stability of the Eurozone or the breakup of the Eurozone, until Governor Draghi came out and said whatever it takes. That was the day when we could stop intervening, the pressure was gone. And then we did not have to intervene, and you can see here that we were above this 1.2, not a lot, but still a little bit for most of 2013, 14, and then in 2014, when it became clear that the ECB would loosen and this divergence that we have also been talking about would come along, that's exactly when we started to have problems, given that we had this floor against the euro only, and we had this change between the euro and the dollar, and it was the euro that was weakening. It was not so much an issue of Swiss franc strength anymore, but the weakening of the euro against all other currencies, and we had to start to intervene again quite significantly. I saw from the presentations earlier too that in Israel the foreign exchange reserves did about triple, I think. In the case of Switzerland, it was more than tenfold. We went from about $50 billion to about $600 billion. Our foreign exchange reserves are currently about 90% GDP. So it's a significant amount of foreign exchange reserves that we have to handle, which creates, of course, problems on its own, since you have to manage those assets somehow. So we lifted this floor in beginning of this year and had another appreciation. At the same time, I think the appreciation of the dollar did also help us to counter this appreciation that we had against the euro. Now here, a slide that probably will surprise you. It surprises me every time I look at it. And this is the performance in terms of, if you look at just the levels of GDP, how countries and the Eurozone performed during this crisis, and you see that Switzerland actually had performed quite well. The US has just caught up with us this year, so the performance of the Swiss economy, if you look at GDP levels, has actually been quite well. In that sense, I think what our policy worked. The qualifications I have to make here are two. One is that we had quite a lot of immigration into Switzerland, specifically from Germany. So if you take a per capita view, it looks less impressive. So clearly the Swiss economy was helped by immigration. The second one is that if you look at the different sectors of the economy, there are clearly very large differences. And the problem, of course, is that our industrial sector, machinery especially, they are suffering heavily from the strong exchange rate, and there we have seen a decline, also a decline in employment, while others like pharma, for instance, have done quite well. They are less sensitive when it comes to the exchange rate. Now, question that also came up, what does that low interest rate environment mean for the real estate market? And you can see that we had an impressive, if not to say scary, increase in prices both of houses but also apartments. You see that during the time when most other countries like the US and several countries in Europe had real estate booms, that we did not have the boom. So I don't know whether we are one crisis behind or one crisis ahead in terms of our real estate market, but this is clearly something that has worried us. But the policy at the Swiss National Bank has also been, I think, very clear that we said we do not do a leaning. So we clearly reserved the interest rate policy for our inflation price stability target, and we have to have additional instruments to deal with this, and that's where macroprudential policies come in. Unfortunately, we do not have the same variety of instruments that you have in Israel. We have at the Swiss National Bank basically only one single instrument, and that is the countercyclical capital buffer. But we have used that, so you see that some other things have been going on, but this has mainly been self-regulation. You can wonder how effective that is. But the two blue squares here are when the Swiss National Bank did increase, or is it not the blue? We did twice increase the countercyclical capital buffer, and our experience so far has been that we think at least that it contributed, maybe together with other measures that have been taken, to slow down the dynamics in the real estate market. So we are still worried about the levels, but here, for instance, two indicators which seem to suggest that at the most current end of the period that we have a slowdown in the dynamics. So this is not over, this issue, but this is clearly one of the concerns we still have. But we do see here some positive developments that we do not have a further acceleration of the risks in the real estate market. Thank you.
So we move to our final speaker, Professor Erd Huben from the Dutch Central Bank, Director of the Financial Markets Division.
Let me start by saying I'm very honored indeed and thrilled to be here today. And the question is why. Nathan sent me a very informal email. I think it was no longer than one sentence. Do you want to what do you think about coming to Israel? And I really wanted to come. And so why? And I didn't even know what Hanukkah was. So why did I want to come? I wanted to come, first of all, because I know that we are members of the same family of central banks within the IMF constituency, but also because we are like-minded, small, open economies facing a lot of challenges. Secondly, because I know Israel has a lot of very talented economists, and I thrill at the thought of being amongst you. And thirdly, because you're quite courageous, and I think particularly of the steps you've taken in the macroprudential field, and a lot of countries look at what you're doing and are trying to look and share lessons with you and with each other on how we should move forwards. So I'm thrilled to be here. The topic I thought I would address today is I think what is a prime challenge moving forwards. And mind you, I think it's a big challenge for Israel as well, because it's the challenge of what small, open, surplus economies do in the face of a flight to safety. This is a challenge which is the opposite of what Barry analyzed in terms of sudden stops and tapering tantrums and other issues when during the crisis you have capital outflows. During the crisis, these countries actually have capital inflows. And a lot of, thank you. And the common thinking, I think, is that countries deal with this differently, and that the more you are at the extremes of either having a very flexible exchange rate regime or having a very tight exchange rate regime, the easier it is, and that everything in the interim becomes more difficult. And I think the Swiss case might be one which is slightly more in the interim. But what I want to show is that even countries inside a monetary union have difficulties and face difficulties when that monetary union is put into question. Let me give you the 4 upshots of my presentation, which is very short, directly, to take out all the excitement. First is that very small, open, surplus economies are vulnerable, and they're vulnerable to large inflows, and you have to think of the instruments you can embark on to address that. Secondly, that ultimately the credibility of your monetary policy regime is key. As long as it's very credible, markets view it as credible, then you have a much bigger chance of surviving the onslaught of the capital flows. Thirdly, that the rule of Jan Tinbergen does actually apply. For every objective you have, you need a separate instrument. So if you have one objective of price stability, you have one instrument. If you also have an intermediate objective of your foreign exchange or your exchange rate or your asset price developments or even your domestic spending, think you really need to have other instruments to be able to address more than one objective. Okay, so let me just go very quickly through the analysis of how we arrive there. First is a simple overview that countries like us are not the biggest. And I've basically taken as the measurement the size of the US economy or the EU 28. I should have probably taken the EU 19 of the euro area, and I've compared that to the Netherlands, Switzerland, Israel, and Denmark. And clearly, we're very small. At the same time, we are very open. Israel is twice as open as the US, and in the case of the Netherlands, we're about 4 times as open. Another important thing is that we have persistent surpluses. And I understand that since about a decade, Israel has joined this community of countries. And Israel has joined not only the community of countries with strong balance of payments, but it has also joined the community of countries with institutionally credible and very strong central banks. And that makes a difference because it has an influence on the direction of the capital flows. The next interesting thing is that when you look at what countries did, that Denmark survived the onslaught of exchange rate pressure, and Switzerland didn't. Now, I don't want to pass any judgment on any country. I just want to do the analytics. We had Niels's chart, which actually went back to 1982 or 92, that you really tightened it. And what you see here, the interesting thing is this. Now, you see, our market's going to just believe it when you do it for the past 3 years. Markets have long memory. And basically, when you've already appreciated by about 30% in a previous crisis, then when you have a second crisis, markets might still have the memory of what happened the previous time, whereas Denmark managed to pull through. Although I concede that I think the pressures on the Swiss franc are without any comparable measure in the international financial scheme. So we mainly have 2 instruments to do something about large pressures, upward pressures on your currency. The one is the exchange rate, and the second is exchange rate intervention. These are the 2 instruments the central bank has at its disposal. In the case of the interest rate differential, we've seen that the zero lower bound is not zero. We're working out where it is, whether it's at minus 50 basis points, 75 basis points, maybe even 100 basis points, but there is a lower bound. And Switzerland has come quite close to it. And I think the lower bound is also a dynamic concept. The longer you have a negative interest rate, the more difficult it will be not to avoid a financial innovation that tries to make use of that differential. So it is something that becomes more and more difficult the longer you hold it, because you do have certain assets like banknotes that do not carry the negative interest rate. So here you see that both Switzerland and Denmark went all the way with their negative interest rate differentials, as were shown in the previous presentations, to maintain the interest rate. But also you see the massive increase of, wait, let me get the right order. The massive increase of the balance sheets. We have here the balance sheets in percent of GDP on the left-hand score, and for the Netherlands, it's our target 2 balance. And this may be something you don't know, but within the European Monetary Union, we have beneath the bonnet, so when you move to the front of the car and you open the bonnet and you look into the engine room of the European Monetary Union, we actually take account of all the bilateral positions vis-a-vis the center, vis-a-vis the European Central Bank in Frankfurt that occur. So when inhabitants in Greece transfer their funds in a big way to Dutch banks, ING or Rabobank or whatever, they get a surplus, which is an asset, a surplus asset on the European Central Bank, and the Greek banks have a liability and this measure, the target 2 balances, is a measure of the imbalances that are actually occurring within the monetary union. And you can see here that the imbalances in the case of the Dutch Central Bank, which is this orange, reached a peak of about 50% of GDP at the height of the debt crisis in 2011 and 2012. And then it subsided, whereas in the case of Switzerland, they kept intervening, and the assets of the central bank kept increasing. And in the case of Denmark, they were basically flat. Now, the interesting thing here is that if you look at what actually happened in the target 2 balances, they are very closely linked to the credibility of monetary union. So when President Draghi made the statement, whatever it takes, you see that the surplus of the Netherlands, which is this yellow-orange bar here, started to decline. So from that moment also, the target 2 imbalances, these are the imbalances within the engine room of the euro system, started to decline. Now, with the onset of quantitative easing, they are increasing again. But this is because we are all expanding our balance sheets in different ways within the euro system, and some titles are not eligible for purchases, and others are. The interesting thing then is, all right, what happens to the balance sheet of the central banks? And what we see here is that when the statement, whatever it takes, was made, the balance sheet of the Dutch central bank, which is this orange line, started to decline. So the imbalances that were apparent in the accumulation of assets declined. But you also see the immense contribution this one sentence did to the Swiss National Bank, because after this statement, they had quite a period of rest. So the fact that Mario Draghi made this statement and basically said, we will secure the credibility and the sustainability of the euro area, meant that there were much less incentives for euro area people and people abroad to move out of the euro area into Swiss francs. So this is basically this basically indicates that they didn't have any inflow, at least on account of the unrest from the euro area countries. And in the case of Denmark, there was some decline. And basically, you see that after QE was embarked on. With the negative interest rates, again, this is leading to an increase in the balance sheet of the Dutch central bank, but it's also leading to an increase in the balance sheet of the Swiss central bank. And I think, in essence, the rule is that what we do, all countries that mirror our policies and that have their exchange rate linked to the euro system and the European Central Bank have to do the same measures. So the key points are small open economies are vulnerable to flight to safety, surplus economies, and I think that will apply to Israel in the future as well. Negative interest rate differentials run into limits on account of the lower bound. Large foreign exchange purchases also create foreign exchange risks on your balance sheet, which may be considered excessive at some point by the central bank. And that, in that case, as was the case in the case of Switzerland, the peg may become unsustainable. Monetary union proved ultimately to be adequate to protect us, the Netherlands, and I think also Germany in the past, during periods like we've gone through in the past years. It was customary that the Deutschmark and the guilder would revalue by significant amounts. This has not occurred this time thanks to monetary union. And the last lesson I would put at the bottom, but this is that we do have other instruments. And in addition to fiscal policy, I really agree with Professor Eichengreen on that one, but I would emphasize also macroprudential policy, because I think that when you have these emerging imbalances in your asset markets, particularly in your real estate markets, then I do think that macroprudential policy can play a role in dampening those risks. Thank you very much.
We could have used a Danish background. Okay, so the way we would like to conduct this is, so we have about 15 minutes according to the official program, and since we had some delays, we can extend a few minutes. But I'd like to ask a couple of questions, quick, one question or two questions to the panel, and just get your views on current issues. So we heard a lot of, during the earlier part of the day, how academics view monetary policy and what's happening around, and I think it's time to hear some, the policymakers themselves and discuss some of the issues that were raised throughout the day. So I'll start with the big question, I guess, that the governor also raised in her address, the opening address, is what are your views about this divergence of European and U.S. monetary policies in the in the year ahead, probably? What are your expectations about how this is going to pan out, and how would it affect your own monetary policy? So I guess the first question will start from Art and go this way, and then we'll go the other way. So.
Well, I think from the perspective of the euro area, I think it's very clear we have downward pressures on inflation. We have too low inflation for our own liking. If you look at our most recent inflation projections that were the basis for the recent announcement of monetary policy measures 10 days ago, lowering the deposit facility, lengthening the time of our quantitative easing, and announcing a reinvestment policies, then since then the exchange rate has appreciated of the euro, and the oil price is about 10% lower than it was in the forecast round. So clearly the risks are to the inflation objective are to the downside, and this means that the euro system, the European Central Bank, will pursue this divergence as long as needed to achieve its price stability objective.
For us, the divergence, as I tried to point out, was clearly a problem given that we had set this exchange rate ceiling as a bilateral level against the euro. So once the euro and the dollar started to move in different directions, that's when it started to become problematic for us in the sense that it became costly. So we could have clearly continued with this exchange rate ceiling at the cost of a largely increasing balance sheet, but that was the time when we decided that the costs-benefit analysis would suggest that we should lift this ceiling. Now going forward, of course, when we have this divergence in policies, that there will be exchange rate movements, but going forward for us, I think it's less of a problem, given that we are back to a float with occasional interventions. And when the US now starts on Thursday to increase interest rates, that only helps us. So a strengthening of the dollar clearly is helping the Swiss economy.
So, first thing on monetary policy in the euro area and the US, I very much agree with Professor Eichengreen. What you said, the right thing is that. I mean, the U.S. monetary policy reflects that things are going in the right direction in the U.S., and that's good. And they should do the monetary policy which is right for them, and the same goes for the euro area. So this is all I will say about that. For Danish monetary policy, well, the important thing for us is what goes on at the ECB. And so, of course, this is something we follow closely, and yeah, so, and we are prepared to do what it takes to keep the krona rate stable vis-a-vis the euro. There were, if you look back in the recent months, there was an expectation that we would narrow the spread to the euro, the interest spread, simply because of this capital outflow after the inflow, and when Draghi then, or after the meeting in October, came out saying that it was likely that there could be a further decrease in interest rate, we saw this expectation in the market disappearing, and then the expectation was that the narrowing would come from ECB, so to speak. But generally speaking, we follow the ECB, and we are prepared to use the instruments that it takes to keep the krona stable.
Thank you. So I'm picking up on what Erd mentioned before, and I think was also in the presentation by Thomas. We also in Israel experience negative inflation, which is largely caused by oil prices, commodities, and the governor alluded to that in her presentation. And so you have these negative inflation rates, and which is barely, is something which is exogenous to your economy, and so whether I think it was also raised by the paper by Rafi and Alex. Is there a symmetric approach to this negative inflation? Is it something that you think you should strongly react to, or not?
Well, a decrease in oil prices, I think that's I see this as basically a supply side shock, and so how to respond to that? I mean, usually you would say you should look through that. However, I think it's important that I mean it's very important that inflation expectations still are aligned with the target, and I do see some signs recently that this might not have been the case to the same extent as we saw in the late 2000s, where it was clear that the right thing was to look through swings in the oil prices and where inflation expectations were actually unaffected, more or less. So it's important to keep an eye on this, but yeah.
I mean, given that in Switzerland we also have negative inflation, we have not reacted strongly on that, so it's something that we live with. Given that, as you said, a large part comes from imported prices from oil, that's something I think to look through. What helps, I think, is that we do not have an inflation target in terms of a specific target. I guess if you would say 2% is your inflation target, then maybe headline inflation has more importance than when you have kind of a flexible regime where you say we are somewhere between 0 and 2. We are occasionally outside the band and we come back. I think then there is also less pressure to react on these headline figures. So in that sense, I think it's a symmetric reaction is appropriate.
Let me share two thoughts with you. First of all, the world is asymmetric when you have negative interest rates and very low inflation. There is a lower bound, so there is a greater antipathy against things going further south than when things pick up again. So I think there is an asymmetry there, and we are more concerned, I think, about downward risks now than we would be about upward risks. Having said that, there is a concern with being too stimulating with monetary policy on account of what this could imply in terms of the build-up of financial imbalances over a longer-term time horizon. And to some extent, this can have an impact also on price stability, on the central bank objective, as long as you take a long enough time horizon to consider that. And there, I think the measurement should be that if countries and authorities are not doing anything in the macroprudential domain to counteract those imbalances, then clearly monetary policy also has to lean against the wind of the financial cycle and of the build-up of these imbalances. So that's a nuanced, two-sided answer.
So follow-up, I guess, for Thomas and Neil. So is that also your view that if interest rates stay negative for long and inflation is negative for long, then the macroprudential concerns should weigh more heavily?
I mean, the way I view it is negative interest rates have. I don't see that there is really a big difference between having very low interest rates or being negative. So I think it's the same issue for macroprudential policies. It's an issue of having very low interest rates, and but clearly in such a situation you need to have additional instruments, and macroprudential policies, it's the only game in town that we have. I don't think that the Swedish experiment of raising interest rates in such a situation has been too successful. So I think macroprudential policies is clearly the way to go. I also would like to say on negative inflation, for us, this is also a way to gain back competitiveness. So if you have an overvalued exchange rate, of course, it would be much easier to have a nominal depreciation. But if we have negative inflation, that's one way to get the depreciation in the real exchange rate. And since everyone is very low with inflation, and Switzerland is generally a notch lower than everyone else, I think that's the only place that we find ourselves in, is in a negative interest rate and in a negative inflation rate environment. So that's why the lifting up of interest rates again from the US is very important for us, that we get this room again to go back into this normal positive territory.
So I agree fully with you, Thomas, and especially I think one should be careful not to stretch monetary policy too far, as we've seen with the Swedish experience. So yes, macro-potential tools are important. I can only agree with that. I will mention, however, also that there's another tool, and that's fiscal policy. For instance, I mean, I think it is important. I am a believer in automatic stabilizers, and automatic stabilizers also in the housing market. So the taxation of houses is important, that you see some stabilization through taxes. But I fully agree with what you have just said.
The only thing I would say, you're asking, should we do something with macroprudential policy? I've just done some research over 82 countries, including Israel, including every country with data over a period of more than 25 years on the effectiveness of macroprudential policy to the extent one can measure that countries actually implemented macroprudential measures. And there are two very important findings from this research. The first is that macroprudential policy works. So it really has a substantial impact on credit growth and on banking, in particular banking sector credit growth. The second point is an important point, is that it does lead to substitution, so it leaks. And it leaks both cross-border. Now there was significant other analyses that already pointed to cross-border leakages, but it also, and that's the first thing that was the first time in this study that we established this, it also leaks cross-sector. So when you start tightening banking sector regulation, you find all sorts of financial innovation that circumvents the banking system. So this is basically to energize all economists, and particularly also supervisors, to think of what happens when you tighten regulation for banks, what is happening to non-banks, and what can you do to bring them within the orbit of the same policy stance, because you basically want your policy stance to influence the whole financial sector.
Thank you. So we have time for a couple of questions from the audience. So Barry.
The first one was motivated by the interesting slides on Denmark. So it sure looks like negative interest rates help you hold an exchange rate peg. It also looks like they do so at the expense of the pension funds, which is not obviously socially desirable or efficient. Either the pensioners are going to get less in the future, or the fiscal authority is going to have to step up and fill the gap. So is that a worry? And the related question is, I am struck by how every central banker who has spoken today has invoked the mantra of a 2% inflation target, where everything I've heard about unconventional policy and 2% and negative interest rates suggests that given what we know now, have we all decided that 5% was an appropriate target? In response to these deflationary pressures, we could have cut rates by 500 basis points and not have to be so creative as central bankers.
So on pension funds, well, of course, negative interest rates are costly to people who save. And that's exactly, we want people to spend more and save less. I guess this is why. But on pension funds as such, the important thing I think is what have they made in terms of guarantees. And Danish pension funds, they used to give guarantees to people savings, but they have moved out of that to a great extent. So in that sense, well, of course, people then get less out of their savings, but everybody does so, and we can cope with that. Of course, it would be a problem if you had a lot of guarantees of some nominal yield on your savings. This has been reduced quite a lot in recent years. So, yeah.
Pension funds is a political issue that has come up in Switzerland, but one thing to point out is, so there were some initiatives to try to exempt pension funds and so on, but I think an important point that Niels pointed out in his presentation is that it's not just the foreigners that contribute to this appreciation of the exchange rate, it's the domestic investors too, and pension funds are a large part, and we saw the same thing. We have also fully funded pension system, they have huge amounts of investments, and they clearly cut some of their investments abroad, so they brought back money into Switzerland, which contributed to the appreciation of the exchange rate. So my response usually is go back and invest again the same amount that you had before abroad, which would help us and which would help you to avoid the negative interest rates. The second point is, given that we have negative inflation, the real interest rates are not that negative. They have been much more negative in the past. Depending on how you measure it, they might even be positive. So it's not such a huge drag, especially also when you compare it to all the other problems that we have with the pension system that need to be fixed. And I have to remember the second question you had. I wanted to say something, but I forgot.
5% inflation.
I think this is an important issue. So how can you deal with this lower bound? Maybe also with the prospect that we are faced more often with this lower bound problem in the future. I think one important reason why not to go to 5% came from the presentation from Alex Zuckerman, and that is that when you increase the level of inflation, it's also the variability of inflation that goes up. So when you have a very much higher variability, and you are sometimes at 10%, sometimes at 2%, I think this is much more costly for the economy than trying to be below 2%. But then you have to think about how to deal with this problem in the future if it is going to stay here. And my suggestion would be to seriously look into the use of negative interest rates as a tool for monetary policy.
To start off with the pension funds and the life insurance companies, my country has very, very large pension funds and quite large life insurance companies, about two times GDP in total on assets. So they've suffered a lot. And we first maximized the discount rate, or we set a floor at the discount rate they had to use, the ultimate forward rate at 3.8, which sort of mitigated the circumstances for a few years. And now we're slowly lowering that, but we're not bringing it down to where the market rate is yet. So that cushions the impact a little bit. But the fundamental point is that when we look at the pension fund sector the whole time, we have to keep ourselves alert that when you look at the pension fund sector, it's a sectoral, a very partial perspective you have, because the pension fund is one of the sectors that has to benefit most when the economy takes off again. So the pension fund will agree that if we help with monetary policy to get the economy moving, then that is an overriding objective that as it were, mitigates the short term, the temporary concerns on the solvency of the pension fund. But there are pension cuts and all sorts of harsh measures need to be taken in the interim until the economy has recovered. On the 5% inflation target, I think there's one issue of should we have moved to 5%, and the other issue is should we move to 5%. Whether we should have moved to 5%, I think 5%, the controllability of inflation declines as it increases. The question is whether then 2% is an ideal or something slightly higher. We've come across the disadvantages of very low inflation, certainly. But at this point in time, we can't even get inflation up to 2%, let alone to 5%. So the debate on whether we should move to 5% is not a debate we should be, at least we feel, is not a debate we should be running now as central banks. The second point is that we still don't know how costly limited disinflation is. Small negative inflation, we don't know yet whether that is as terrible as it were, as we thought they were. The analyses of the BIS in particular, I think it was in the March BIS issue this year, that price declines are not at all disruptive unless they are sustained and when they really get anchored into expectations and become self-sustaining. But if they don't, that it's not so destructive to have negative inflation, I think are quite telling.
Okay, thank you. I guess we have time for one more question because. Okay, 60 years. We're forward-looking. That's okay.
It's a slightly loaded question, and actually directed more towards you, if permitted, for the conductor of the panel to also answer, but also to the rest of the participants. Regarding Israel, well, for the rest of the participants, the three, the question is, would you recommend Israel going down the path of negative interest rates? With maybe the limited or not knowledge, what's going on with the economy here. And Nathan, if you, after hearing these speakers, is there something that sticks out that says it may have worked for them, but for these reasons it's less applies to Israel, or we would be more wary in going down that path? It's sort of a two-pronged question.
Okay, so I'll let. So take the second one, I guess, and answer both.
I was interested in the comparison between Denmark and Switzerland in terms of the exchange rate regime. In particular, Denmark being able to hold on to the exchange rate regime. And of course, we've always said that you can run out of reserves, but you can always go as much as you want the other direction. You mentioned the cost-benefit analysis. I was wondering if you could expand a little bit on what the cost you saw from getting off the fixed exchange rate in that circumstance.
Okay, so I'll let you.
That's the question I expected from Barry Eichengreen, actually. So I think, the big difference is that Denmark has an exchange rate objective. So if I would have an exchange rate objective, I would do it like Neil said. I wouldn't care about the balance sheet. And as you say, buying foreign exchange and producing your own currency is relatively easy, especially also if, like also Denmark, if your interest rates are lower and you actually make money on the foreign exchange. So the objective in Denmark is clear. In our case, the objective is price stability. We don't have an exchange rate objective, and we did this ceiling as a temporary measure. So I think the costs I would say, are threefold. And starting now with this difference in the objective is a pure political economy difference. I think we don't like to talk about this issue too much as central banks, but clearly this is one of the costs that you have, that people start to wonder why you actually do this, why you have such a large balance sheet, why you take all these balance sheet risks. There are issues of losses on the balance sheet which have fiscal effects if you don't distribute profits anymore. So these are some political economy costs that come along with it if your objective is not the exchange rate. Second, so we always say you can do that limitlessly, but it comes with costs. One is that the other side of this increase in exchange reserves is that you have a lot of liquidity out there. There comes the day when there is a normalization and you have to withdraw this liquidity. And I think to this stage, I haven't seen any other central bank to try to withdraw more than its GDP in terms of liquidity. So this is an exercise that is still ahead of us. We believe that we have the instruments to do it, but it will still be something that it will be uncharted territory too, to withdraw so much liquidity on time, not to produce inflation. So that's the second cost. There is a risk there that you, in the future, will mess up on being timely and effective on withdrawing liquidity. A third one, which usually, especially you don't think about it if you don't have to deal with the problem, is that you have to somehow manage these assets. So you have to invest that. It's not that you just can have an account at the European Central Bank and have that increase to whatever level that you want. But you actually have to start to invest this. You have to diversify, which in the case of Switzerland was relatively easy. That since we did not have a lot of limits in terms of how we can invest our foreign exchange. So we are not just bound to bonds, but we can go into shares, we can go into emerging markets, we can go into corporate bonds. So we can diversify our portfolio. But if it becomes larger and larger, you become a very large investor, and you take on some credit risks. You take on some burdens that you don't think as a central bank that you have to deal with. For instance, we have a large share of we have about 18% of our foreign exchange are in shares, in stocks. So you become a large investor into companies. There are immediately political issues that come up again. There are ethical issues that come up. The parliament starts to ask, why are you in this company and why not? Do you exclude certain companies, for instance, that do a lot of environmental damage? So you get into all sorts of things that you do not want to get into as a central bank, and I think that's also part of the cost, just managing the large amount of assets that you have.
Very shortly, I'll just take the first question. Should the Bank of Israel go into negative territory, I would leave this fully into the capable hands of your board. If you just ask me as a sort of outsider, if your objective asks this, then surely you should do it. But you should take account of the risks this means for potential financial imbalances in your country. One thing I would give to you from my country is don't only look at the financial imbalances in the banking system, but also look at the financial imbalances within the household sector. And I know that in macroprudential policy instruments, one often looks primarily at policy instruments that impinge on the banks, but you should not be too conservative on also doing things on the household sector when you give so much monetary policy stimulus. The second takeaway I would have for you is be very cautious on your on FX imbalances, and they may be in the households or in the corporate sector. I don't know how resilient your economy is to financial to FX market mismatches, but given what may happen to exchange rates and such like, I think that would be something that from a macroprudential perspective you should be very alert about.
So I will not give advice to the Bank of Israel either, only stressing that the reason why we went into negative interest rate was to keep this krona rate stable. And I do think that the real economy impact of this still has to be assessed. And the second question was not so much to me, but I have one thing. Maybe it's a question for you, Thomas. But so how should you invest these reserves? I mean, and manage these. I mean, the counterpart of this, the liabilities are short-term deposits by banks in our case, and so this calls for just managing reserves in the way that we have always done. So very liquid and with low credit risk, so we can use them when we need them. And given that the liabilities are these short-term deposits by the banks, I don't think. I mean, the right way would not be for us, at least, to invest them in other types of assets. No, you don't have.
Give us some advice? Or?
So, well, negative interest rates, I mean, I can only say if you do it, you take a lot of political heat. people don't like negative interest rates. Interestingly, they don't mind negative real interest rates, but they don't like negative nominal interest rates. So there is a lot of political heat involved. On the other hand, I think the experience of Denmark, Switzerland, the ECB shows it works in bringing down the interest rate, the entire interest rate curve, so you have transmission. One interesting thing that we experienced, and I think the same was in Denmark, is that there is one exception, and that is the mortgage market. So in the case of Switzerland, all interest rates came down, except mortgage rates actually went up. And our analysis or also market intelligence shows that's the way that the banks cross-subsidize, basically from the fact that they are not willing to extend negative interest rates on retail customers. So they do it on firms, they do it on institutional investors. In the case of Switzerland, I know that they pass on up to 3% to firms and to institutional investors, but they are not going to retail customers. So there is one change now, actually, that one bank, the first bank, now announced that from January 1st on in Switzerland, they will charge negative interest rates on retail customers. So it's going to be interesting to see how that works out. But so far they have, in general, they have avoided that, but they have compensated that by increasing slightly the mortgage interest rates, which in our case, where we are worried about an overheating of the real estate, was actually a welcome outcome. So if you want to stimulate the economy in the usual sense that you want to stimulate aggregate demand, there is this issue with this paper currency that might not give you the full transmission as in the positive area. If the main aim is to weaken the exchange rate through the money market, there it works perfectly well.
Thank you. So just in conclusion, so part of the in every one of our monthly statements, and the Monetary Policy Committee in Israel meets every month. I had another question about what about the frequency of meetings, but we'll leave it for another meeting, but another conference.
In Denmark's National Bank, we meet every day.
So there you go. Thank you. So our governor thanks you. So we meet every month, and every month we issue a statement saying that we weigh the situation of the Israeli economy and we can take appropriate action. And we mean what we say. So we look at every month. Now, what we've heard here, and I think part of weighing the options, obviously looking at all these instruments that other countries have used, and we learn from that experience. So that's, we learn from these things, and we can do whatever, in terms of learning and trying to assess what these things do. And so that's in terms of the learning. And also, as Ert said, and I think it's also good for the concluding remark, is that, so when I asked him to come here, so he says, why me? But I'd like to come, but there are these small economies, and we like to compare ourselves to the advanced, open, small economies that have surpluses. And I think in that sense, we share a lot of commonalities. But Israel also has some differences with the members of the panel here. So although we play our soccer in the European leagues, we're not that tight to the euro as my colleagues here. And in some sense, we have to look at the differences also, and that's just the commonality. So we assess these things every month, and that's kind of the response. So I'd like to thank our distinguished colleagues, my colleagues from the central banks, and I think you've witnessed a very candid display of central bankers, which is quite rare, and I thank you for that. Thank you for being so open with both your presentations and your comments to the questions, and thank you very much for attending the conference, and I'd like to thank the organizer of the conference, people at the bank that made this possible, and wish you a good evening.